Welcome to this explainer. Look, if you've ever stared at the goods and services tax return process and felt like you're literally drowning in an alphabet soup of acronyms and deadlines, you are definitely not alone. Today, we're mapping out the entire 2026 GST return lifecycle, and we're going to break down exactly how data flows from a single simple sale all the way to your final tax payment. Let's dive in.
Here is a roadmap for today. We'll start with the overall GST return lifecycle, then zoom in on GSTR1 and outward supplies. From there, we'll unpack the massive new invoice management system, the IMS, and GSTR2B, see how it all converges in GSTR3B, and wrap up with some crucial edge cases. Let's get right to it.
Section 1. The GST return lifecycle.
So the GST return cycle is really a continuous, highly automated ecosystem. Just look at how incredibly tight this chronological backbone is. On the 1st of the month, your GSTR1 opens up to report the previous month's data. By the 11th, for a regular monthly filer, that GSTR1 is strictly due. Then, all this magic happens in the background. By the 14th, the system generates your IMS pool and your GSTR2B based on whatever your suppliers filed. And finally, by the 20th, your GSTR3B is due, which is where you settle up and actually pay your taxes. It's basically a relentless, automated domino effect.
But before we move forward, we absolutely have to talk about aggregate turnover. The timeline we just looked at was for a monthly filer. Now, if your turnover is under 5 crore rupees, you can opt for the QRMP scheme, quarterly return, monthly payment. But here is the catch, and it's a big one. Aggregate turnover is calculated pan-wise, not by individual GST numbers. So say you have a branch in Delhi making 4 crore and another branch in Maharashtra making 2 crore. Well, your aggregate turnover is 6 crore, and you are disqualified from the QRMP scheme across the board. It's a massive detail that trips up a lot of businesses.
Moving on to Section 2, GSTR1 and outward supplies. There is an absolutely crucial distinction between two words we use interchangeably in everyday life: sale and supply. It's a common myth that GSTR1 is just for your sales, but GST Law Section 7 defines supply way broader than that. For instance, if you transfer goods between your own branches in different states, like moving stock from your Delhi warehouse to your Maharashtra branch, even if no money changes hands at all, that is considered a deemed supply under GST.
Okay, I love this classic trick question for accountants. Take a second and just guess the answer in your head. If you miss that 11th of the month deadline for your GSTR1, do you get hit with a late fee?
The answer is actually a total trap. Technically, when you file late on the portal, you won't see a late fee automatically pop up on your screen. Because GSTR1 doesn't have a payment gateway directly attached to it, the system kind of just lets it slide. But do not be fooled. The law clearly states that late fees apply. The department completely retains the right to send you a legal notice months down the line demanding that exact penalty. So you won't pay it instantly on the portal, but you are absolutely still on the hook.
And all of this builds into a real game changer of a feature, the GSTR1A. Historically, if you made a mistake on your GSTR1, you couldn't just revise it. You had to wait and fix it in the next month's return, which, let's be honest, created massive headaches. Well, now the government introduced GSTR1A. It opens right after you file GSTR1 and stays open until you file your 3B. It essentially lets you amend errors, add missing invoices, and fix your data immediately. The government built this so you stop messing around with manual changes in your final 3B return. They want the whole process fully automated.
All right, Section 3, the new IMS and GSTR2B.
You can think of the IMS as a giant digital waiting room. Step 1, your supplier files their GSTR1. Step 2, instead of going straight to your tax return, those invoices land in your IMS pool, where they just sit. Step 3, you, as the recipient, have to go in, review this pool, and take action. Step 4, only based on the actions you take does that data finally flow into your GSTR2B, which is what actually calculates your input tax credit.
Once those invoices are sitting in your pool, you've got 3 choices. You can accept them, or honestly do nothing, which counts as a deemed acceptance. You can keep them pending if, say, you haven't actually received the goods yet. Or you can reject them outright if they are incorrect or fraudulent. And here's the kicker. Your actions have immediate consequences. For example, if a supplier issues a credit note to reduce your tax credit and you hit reject in the IMS, this system instantly increases your output tax liability in the very next month to balance it out.
Which brings us to a huge, fundamental shift in how we view GSTR2B. For years, accountants were taught a very specific rule about this form.
Is it a static return? Like, once it's generated on the 14th of the month, is it locked in stone? The answer used to be yes, but today, it is a resounding no. Thanks to the new IMS pool, GSTR2B is now a fluctuating return. If your 2B generates on the 14th, but then you log into your IMS on the 16th and reject a couple of invoices, you can actively hit a button and regenerate your 2B with fresh, updated data. It's a live, breathing document now, and it's totally dependent on your IMS actions.
This brings us to Section 4, Finalizing Taxes with GSTR3B.
Notice how this entire automated flow perfectly funnels everything into one master calculation. Your output tax automatically drops in from your GSTR1 and 1A. You manually add interest if that applies to you, the system auto-adds your late fees, and then it subtracts your input tax credit, which flows directly from that newly regenerated GSTR2B we just talked about. Whatever is left over at the bottom is what you pay. The government's ultimate goal here is to make these fields completely locked down, totally removing your ability to manually edit them.
Now, here's a scenario that literally causes pure panic for new accountants. Your 3B is due on the 20th, but life happens, there's a delay, and you finally file it on the 25th. You log in, bracing yourself for a penalty, but the late fee box shows a big, fat 0. Did you just get away with it?
No way. The system is just playing the long game with you. Late fees for GSTR3B automatically roll over and populate in the next month's return. So you file January's return 5 days late without seeing a fee. But when you log in a month later to file your February return perfectly on time, bam, you get hit with a late fee from January. It creates a confusing but highly automated delay that you absolutely have to be prepared for.
Finally, Section 5, Crucial GST Edge Cases. First up, you've always got to remember the system strictly differentiates between invoice value and taxable value. So for example, say an online course is sold with a base price of roughly 11,999 rupees, plus an 18% GST of about 1,830 rupees, making the grand total exactly 12,000. When the GST portal asks for the invoice value, they want that 12,000 rupee grand total. If you accidentally punch in the base taxable value there, your return is going to be completely mismatched.
Now let's look at one of the trickiest concepts out there, place of supply mismatches. Imagine you're a business registered in Haryana. You travel to Delhi for a meeting and stay in a Delhi hotel, and you hand the hotel your Haryana GST number. Well, the hotel is in Delhi, and the service is physically consumed in Delhi, so the place of supply legally remains Delhi. The hotel has to charge local Delhi CGST and SGST. But because you're registered in Haryana, that local Delhi tax is completely useless to you. Your input tax credit becomes totally ineligible, and you just lose that money entirely. It is a really harsh reality of a destination-based tax system.
And finally, an edge case regarding fraud. We really need to talk about the credit note scam. Recently, the government allowed credit notes to be issued without linking them directly to the original invoice number, mostly to help the medical and pharma industries out. But scammers found a loophole. They're sending out these tiny 50 rupee invoices to random businesses and then immediately issuing massive 1,000 rupee credit notes against them. Because of the automation we've been talking about, those fake credit notes flow right into your system and fraudulently reduce your eligible input tax credit. It's a massive headache, and you have to actively catch and reject them in your IMS pool.
And that brings us to the end of our explainer. I want to leave you with this provocative thought. The government is rapidly closing every single manual loophole, from the GSTR1A replacing manual 3B edits, to the IRSMS pool acting as a live, fluctuating gatekeeper for all your credits. Automation means there are fewer and fewer places to hide errors or delays. So you really have to ask yourself, are your accounting practices moving at the speed of the IRSMS pool? Because as we head into 2026, mastery of this automated flow isn't just a basic compliance task anymore. It is absolutely about survival for your business. Thanks for watching and keep learning.